Fund managers love to circulate scary charts, and the latest one looks frightening indeed. It shows a big sell-off in junk bonds heralding the end of the credit cycle. At the same time, complete ignorance of this by complacent shareholders who've pushed the S&P 500 back to within 3% of its all-time high. Now, the scare story is easy to build. Companies have spent the past 5 years taking advantage of easy money to borrow heavily in order to hand cash back to shareholders. In the past 2 years, they've gone even further, with cheap loans fueling an intensifying takeover boom. According to Goldman Sachs partner Rob Pulford, chief executives are now getting anxious if they're not getting in on the M&A action. As the US Federal Reserve propels finally to raise interest rates, it looks like the flow of cheap money might possibly be coming to an end. Not only are short-term safe government bond yields on the rise, but riskier yields are rising even more as corporate defaults begin to inch up. If companies respond to the loss of cheap money by no longer gearing up to buy their own shares or the shares of their competitors, then that means less demand for shares and, all else equal, lower prices. There are a couple of counter-arguments. Most obvious is that the actual yields on riskier bonds, or indeed of the spread of the yield above safe government bonds, aren't a reliable sign of broader trouble ahead. This chart shows how junk bond yields have moved since the start of 2008, with and without the troubled energy sector. The red line shows the overall market and the blue line shows the market excluding energy bonds, and this is showing the yield. Obviously, a higher number means investors are more worried. Now, they're still not back to yields as high as they were in 2011 after the US was downgraded. I should say the same pattern applies to spreads as well. This isn't just about moves in government bonds. Now, while markets did wobble back in 2011, it wasn't a sign that the credit cycle was over and that easy money therefore was coming to an end. Same goes for higher yields. In fact, the last credit boom back before the crisis only really got going once the Fed started raising rates in 2004. You can see on here the blue line shows overall corporate borrowing for non-financial companies in the US, and then how they use the cash, with this these dark bars being the most important. That's buybacks and takeovers. And the boom, well, the borrowing only really got going at all at the point where the Fed was raising rates, and then intensified as the Fed carried on raising rates. Now, it's always possible that Janet Yellen will mutate into a hawk, but investors widely expect the Fed chair to announce a dovish hike next week. That is, higher rates accompanied by a lowering of predictions for where rates will go in the future. Back in the dot-com boom, you can see at the beginning of this chart, companies did very few buybacks because shares were so overpriced that it made more sense for companies to finance themselves by issuing equity. In the credit bubble, which burst in 2007, companies preferred to gear up and cut their share count, that is, buying back shares, which is something that's been repeated, if not to quite such a large extent, in the past few years. You can see buybacks have been a big chunk of the borrowing. Now, the second counter-argument is that the troubles in the credit market are really mostly about oil companies, particularly shale. The energy sector has been the hardest hit of all junk bonds, and you can see just how closely it moves with the oil price. The red line here shows the spread of energy junk bonds above safe government yields, and the blue line is the oil price, which is upside down, inverted scale, just to show how closely the two move together. The cheaper oil is, the more likely the highly geared shale companies are to default, and so the higher their spread. Energy companies are still 14% by value of US junk bonds, even after their collapse in the past 18 months or so. But by contrast, in equities, energy companies only make up 6% of the S&P 500. So you should expect a divergence between shares and bonds, as bonds are hit harder by the falling oil price. Still, it's true that the problems in corporate bonds aren't confined to the oil sector. We did see on that first chart, you can see that even the non-oil, the non-energy sector, the blue line, has seen yields rise a fair bit. Investors are running scared in particular of the weakest credits within junk bonds as well. Now, either this is a sign that companies have gone as far as they can in taking advantage of bondholders in order to help shareholders, or like 2011, it's a great opportunity to pick up junk bonds on the cheap.